Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I'm a mediator and business valuation expert in St. Louis, Missouri. Today, we'll be talking with Kelly Finnell. He is based in Memphis, Tennessee, and is one of the nation's best ESOP consultants, having spent more than 40 years helping business owners design and execute employee stock ownership plans. Kelly is also the owner of a preeminent ESOP book, the ESOP Coach, using ESOPs in ownership succession planning in 2010, and his work remains the most comprehensive guide to ESOPs today. Welcome, Kelly. How are you? What are the primary tax advantages associated with ESOPs that would convince a business owner that this is a right move?
Well, there are tax advantages for the business owner and for their company. So first, for the business owner, under Section 1042 of the Code, which is a like-kind exchange provision, the business owner can sell their stock to an ESOP, reinvest in the stocks or bonds of a different U.S. domestic operating company, and that's considered a like-kind exchange. I had stock in my company, I sold it, I got cash, and I reinvested that cash in other stocks or bonds. And so those would be very conservative income producing, typically U.S. public companies. And so by doing that, the business owner is going to avoid the long-term capital gains tax on that sale. So it's like, most business owners that I talk to have done throughout their career, like kind of exchanges of real estate. And so I draw that analogy because the concept is identical. I have a piece of property, I sell it. I have a gain, I reinvest the gain in similar property, no tax. I do get a transferred tax basis. Okay. So if I ever sell the reinvestment property, then that's going to trigger the gain, and my basis in the property that I reinvested in will have been that transferred basis.
Okay.
One of the differences is that most of the people that are doing ESOP transactions are mid-60s to mid-80s. And so they're going to reinvest typically in assets that they can hold on to till death. And at that point, their heirs will get a stepped up basis. So it's either a long-term tax deferral or in some cases, a complete tax forgiveness.
Okay.
So that's a very powerful tax benefit for the selling shareholder to be able to save that 23.8% federal long-term capital gains tax plus any state long-term capital gains tax. Then there's a big tax advantage for the company, and that is 100% ESOP-owned companies operate on a tax-free basis. No tax at the company level because they're all S corporations, and S corps don't pay tax. They flow their income through to their shareholder. And as I mentioned earlier, an ESOP is a form of qualified retirement plan like a 401k. Like a 401k plan, it's going to have a trustee. And like the 401k trustee, the ESOP trustee is going to be tax exempt. So what happens if you have a company that doesn't pay tax and flows its income through to a shareholder that doesn't pay tax? You have public supermarkets, which is the largest 100% ESOP-owned S corporation in the country. And they compete very well with Kroger because they have the huge pricing advantage. They don't have to distribute 40% of their income to their shareholders so that the shareholders have the cash to pay the tax. There is no tax at Publix or at any of the other 6,000 ESOP-owned S corporations. So huge tax advantages for the shareholder and for the company that sponsors the plan.